Today I'm going to show you an amazing scalping strategy that takes advantage of the first few hours of market open. And the best part, it's simple, repeatable, and effective. I've been trading for 9 years, and one thing that I've learned is that most of the opportunity is going to happen within the first couple hours of market open. So if we master the open and learn how institutions treat it, we can exploit this and find daily opportunities, but this requires the right type of trading strategy to be able to navigate. So in this video, I'm going to share with you my scalping approach, and you're going to see why this has quickly become one of my favorite strategies to execute that I've been using this entire year to consistently find solid trades. So I'm going to first break down the strategy into 3 simple steps and how exactly I set it up. Then I'm going to run you through several different examples of this happening within a close time frame of one another so that you know I'm not cherry picking opportunities. Then at the end, I'm going to show you recordings of me trading this in real time so you can see exactly how I apply it. It's going to take some practice, but I promise by the end of this video, you should see how effective this can be. Okay, so step 1 of this strategy is going to start off on a 1-day time frame. So you'll see on my screen here, I have a 1 minute, which is where we're going to be executing our actual entries. And I have a daily chart here. What we want to do is first mark off the previous day high and low. So what I'm doing is going over to a daily time frame here on my right side, and I'm just going to use this tool here to mark off my high, and right here to mark off my low. So I told you, pretty simple so far. Previous day high here, previous day low here. I'm going to explain to you why we're using this in a second. And this model has been tested on the future side, on MES and MNQ. But for today, I'm going to be doing an example on the crypto side. All right, so nextly, I'm going to move down to a 15-minute time frame. What I want to do is go back to the last couple days, and you'll see by these gray zones, I have from 8 to 9:30, which is going to show me the New York Stock Exchange open and sort of segment out the opens for the day. Largely, we're going to be trading around this open time frame. So I just kind of want to look at the last couple days of price on the 15-minute time frame. And what I really want to do here is mark out my 15-minute fair value gap. And what a fair value gap is when you have a sequence of 3 candles where the first candle's wick high or low doesn't overlap with the third candle's high or low. In this case, price is moving up. So we want to look at the high of the first and the low of the third. And if there's a space left between there, usually a significant space proportionate to the other movement on the chart, we're considering that to be a fair value gap, but it can go in both directions. So I'm just going to use this box tool here and start identifying key fair value gaps. So first one that I'm noticing is right here. So I'm going to mark off that area. Second one that I'm noticing is from here to here. So I'll mark off that area. And the last one that I'm seeing here, we have kind of chop in between here, and we have this one right here. And then if I look here, I also have a small bullish fair value gap here. So we'll also take note of this. So now we have step 1 complete. We have our previous day high and low levels established, and we have high impact areas for the current trading session that we're going to be using as key points. Now, the reason this is important is because both at the previous day high and low and at the midpoint of these fair value gap levels are high impact areas for institutions to want to execute their orders. Institutions need liquidity in order to fulfill their positions. Typically, retail traders are going to place their stop loss levels outside these previous day high and low levels. They're also fundamentally important areas, and these fair value gaps tend to be areas where there's excess orders, where price tends to want to gravitate to in order to reach equilibrium. Okay, so we're going to look at these for potential profit areas and signals for entries. And what I like to do is just right click on these and turn the visibility up to 15 minutes. That way I have a clear chart on my 1 minute, but I can still see everything on my 15 minute. And so now all I have to do is basically hover my mouse over the areas here, and I can see exactly where it's going to match up on the other side. But now I have visible clarity on where I'm looking for all of the other details. Okay, so let's get into step number 2. Step number 2, we want to switch down to focusing on our 1 minute time frame. So now what we're looking for is general signals for us to want to enter in the market. So I'm looking for a few key things. So the first thing that I want to do is take one of these trend line tools here and try to find areas where price tends to not be able to bounce through. So I'm noticing we have a downtrend set up right here, and we're getting a response off of this level and this level. And what I'm really looking for is for a trend level to be established, and then for us to get a candle where it's significantly pushing out of this trend line area. And it's creating 2 things. The first thing that we want to see is something called a change of character. So a change of character is basically where we have a lower low, lower high, lower low, lower high, fail to break lower, and then this swing point is being broken up, and now we have a new high. This also needs to produce a fair value gap candle where we're seeing this overlap area. And if we can see this happening out of a reaction of either any of our key levels, so our previous day low, or out of one of these fair value gaps in our range, this is showing us that larger players are stepping into the market, in which case I want to try to enter in at the first signal of this and be able to position myself to ride into the potential of that new direction as we're seeing larger players step into the market. And what we're going to be doing is using all of these areas for signals on what to do next. So I have my trend line drawn. We're now at the 9:30 open. So we're going to play it forward and see what happens. So immediately we get a sell-off in the market. And then you see here, we have a big, what's called engulfing displacement candle. So this candle has attempted to push into the low. You'll see it hit almost perfectly off of that previous day low. We had a massive reaction off of it. So if I play this one candle forward, you'll see after the reaction off of the previous day low, we now have this bullish fair value gap and a change of character out of this trend. So we try to push lower. We see a big displacement candle where institutions lightly put in, change of character, fair value gap. Also, we have this trend level broken. Okay, so here comes the next important piece of information. So whenever we have these fair value gaps, you'll notice if price is going to continue moving in the direction by pushing through them, coming back into them, and then continuing in that direction, you'll see it's very common that these candles don't make a candle close through the 50% line, which is called the consequential encroachment line. So they don't like to close below that midpoint if they're going to respect them. You can see it happening here as well. Midpoint here, price is constantly bouncing, trying to break through it, can't make a close through it, and then continues to move in that direction. So the same thing is going to be true on the 1 minute time frame. Okay, so at this point, what I want to do is set my entry right at this midpoint and place my stop loss outside of the fair value gap producing candle. So stop loss placed out here. And what I'm going to do is just temporarily set up a 1 to 4 risk reward. What I'm going to do with this strategy is keep it open-ended. So I try to let them run as much as possible, but I'm starting off at this 1 to 4, and you're going to see why in a second. And if we go over to our 15-minute time frame, you're going to see that our position is coming almost right up to the midpoint of this fair value gap. So that's going to get us our 1 to 4 right around here. All right, and what this is going to allow to happen is for price to come back down to that point, have a chance to respond off of that gap, which you can see price is closing through the midpoint, but is not closing outside of this gap before starting to make a move in our direction. So now it gets into step number 3. We've entered into the trade. Now, how do I strategically manage this trade? So what I'm going to do is wait for what's called a break of structure, which after we get a push up and then a move down into our entry, once we get a push in a candle close over that swing point, so say my stop loss is originally here, I'm now going to be walking my stop loss to break even. So now we have no risk on the table and only reward once we get that initial response to confirm in our direction. However, we're not necessarily in the clear yet because we do have a really big bearish fair value gap in here, which price has yet to break through this midpoint and close above. So this is going to be a heavy area of resistance that we do want to consider. So see, as I play my candles up through it, we got a very decisive move to the upside into the midpoint of this secondary fair value gap. Okay, so you'll see as the next candle comes in, it ends up closing back down here, but we had a clean break above this level, which allowed me to hold through it, right? We didn't respond and start teetering through this area. We actually moved up here, but then got a negative response off of this midpoint. Before you think that I'm just sort of cherry picking these examples, this is actually a trade that I recently took. So you'll see I have my take profit set exactly at this area. And then as price went through it, this is where I'm closing out my position. So in this case, I just wanted to be able to lock in my 1 to 5 risk reward. However, it all depends on how much we want to hold the trade. So typically what I like to do is keep the trade completely open-ended, especially if we get momentum out of the gate. Say I'm losing on the day. Typically, I like to just play into simple profit targets to make sure that I have profit locked in. However, if I'm in a good position, I will let the trades run. And once again, I'll look to see how price responds off of my next high impact areas on the 15-minute trend. So the next area would be this point. So price retraces down, eventually moves up to this area. You can see first bearish candle comes off of the reaction of the midpoint of this fair value gap. In this case, breaks through it, in which case, once again, we can target this equal high area in that previous day high, which you can see had a temporary response. And then because of the bullish nature of the day, price just continued moving. But you can see even in this example, we're able to make 12 risk factors. In fact, on this trading day, I drew another trend level right here. And considering we had a break of structure over this area with a bullish fair value gap right at the same area of my bullish fair value gap, I was able to re-enter into my trade, still following the same rules, and have the market go up and fill my take profit again. You can see in the recording, I have my entry here. I'm setting up my targets, and then I'm fully out of the trade here. Okay, so now let's look at an example of a different day, and we're going to go through it a little bit quicker. So I start on my daily. I set my previous day high, previous day low value, go down to my 15-minute. I'm identifying my fair value gaps here. And notice here on this price action, I really don't have any important fair value gaps. Even if I scroll out, all of them have already been invalidated or gone through. So I only have this one, and then realistically this one down here that has not been yet filled. And the top of that range is actually coming up to the previous day low level as well. Okay, so we have our daily analysis set up. Now we want to see a response off of one of these areas, as well as our change of character and our fair value gap. All right, so I'm playing the chart forward. So you can see price came up, rejected off of that 15 and closed now below it. Okay, we have price reject again off of this fair value gap. And now we have this trend level forming. And now we're getting a high impact candle is more high impact in the direction of our bias. And technically we have a gap here and a gap here. So once we see that trend level break, we have a change of character in here, rejects off of the middle point, comes in and retests the opposite side of this trend, which is why this is an important thing that I look at, placing the stop loss outside of that retest. Notice how the candle doesn't close below this low level, so we don't reduce our risk yet. Then we finally have a candle close, so stop loss comes down to break even. And now the next high impact area on our chart, as crazy as it seems, is down here at least the previous day low and our next possible unmitigated fair value gap on the 15-minute time frame. Okay, and you'll see over the course of the session, this is exactly where price gravitated to before having a reversal. So you can see that's 19R on a position. So now we have new fair value gaps on our chart. So we have this one, we have this one, and we have our previous day low fully rejected off of. So you can see we have a change of character right here after a big rejection off of that previous day low, a big displacement candle with a large fair value gap left over right here. We also have a clean candle close outside of this temporary downtrend here. So once again, displacement candle, change of character, reaction off of one of our key areas, showing that bigger buyers are entering the market. Stop loss placed underneath this swing low level. Target starts out at 1 to 4, but we also have this fair value gap to see how price responds off of it. Risk gets reduced. We finally have candle close outside of this fair value gap. We have risk off the table. Notice how the price came very close coming back down to our entry, but because we waited for a candle close here, it didn't tag the entry. Now, of course, sometimes it is going to tag the entry. Markets are still going to be random, but that's the ideology around this concept. So if we want to be aggressive on the target and price ends up tagging us for a break-even trade, we didn't quite get to our next take profit level. Not every time these trades are even going to work in the first place, and not every single time it's going to run as much as you want. So everyone can have different take profit managements and figure out what works best depending on how your style of trading works. But we did have a potential opportunity to be able to come up to this point, in which case that's another 1 to 5 risk reward. So let's take a look at another example. We have our previous day high, previous day low set, fair value gap here. This time previous day high gets swept. So the candle tries to go above it and immediately rejects off of that area. Our next important fair value gap on this entire move is here, maybe here, but nothing really super high impact until maybe this point as well. We have this point drawn out, only show that on the 15, trend level drawn, fair value gap in here. Didn't quite have a change of character here, so wouldn't have really entered. We didn't really get a confirmed break of that trend level. Here we get the trend level breaking, but this fair value gap is not yet invalidated. This would be our ideal for price to come up into test into. Entries set up, stop loss outside of fair value gap producing candle, position set to 1 to 4. Close below this swing point, stop loss moves to break even. This fair value gap's our next important area. And you can see price reacts beautifully exactly off of the midpoint of this fair value gap. But you can see that exact area was responded to, and price wanted to, on a larger time frame, gravitate to this next macro area and at the very least have a reaction off of. Something to remember is that we're not going to be right about every single trade. Okay, sometimes the market is not going to work in our direction, but it's about positioning ourselves at least in technical areas where we at least have a higher chance of being able to have these moves. So even though we can't be right every single time, even on my worst day where I have a 27% win rate, by following the process of reducing risk and letting the market play out, I allow big trades to be able to play out while keeping the losses small or at break even, and oftentimes I can really get ahead. On days where the market really wants to run, I'm able to capitalize on really large trades, keep the losers relatively small, and sort of be able to play into that momentum of the market. Historical results don't dictate future performance. However, after 9 years of trading, these have been my findings, and this is a really, really good framework that I like to use to be able to add other things to, add other confluences with the team and work on that's led and allowed me to be very consistent over time. But you guys can let me know in the comments whether you like this approach. Make sure you hit the like button if you're still here. Subscribe to the channel if you like trading and investing and want to know when I put out other videos. I'll put another video of me trading this right here in case you're curious. But until next time, I will see you all in the next video.